Alrighty, let's go ahead and get started. Welcome everyone to TradeFinder Live. Great to be back with you all during this trading day and during trading hours. As always, we do have to cover our disclosure disclaimer agreement. The main thing to take away from this is that we are not licensed investment advisors in the United States, so nothing's to be taken as personal investment advice. Please feel free to take a screenshot of it now if you like, but that's the main point to take away. Other than that, lots of exciting topics to get into for this session. I know we have Rob out there will be joining us shortly. The bond market has calmed down a bit. Is that now good for equities? I'll leave the expert, Mr. Roy, out there to expand on that. So, Rob, you out there?
I am Zach. Happy Tuesday afternoon to you, and welcome everyone to TradeFinder Live. Great to be here with you. And as you said, lots to talk about in this session. So let's go ahead and get right to it. We did have the bond market calm down. I'm going to go to the bond market here in just a second, but let's start with looking at what's going on the S&P. It's more of a quiet day. If we finish where we are right now, then we may have a doji, so we'll watch that. But certainly far less volatility than what we've seen, even though the VIX is still right around 30. It's just under 30 at this point, but still elevated. So anything could happen between now and the end of the trading day. But for now, you can see that a bit of a calmer day. Let's put the moving averages on here. And we are holding above the 10-day moving average. And what I talked to our subscribers about yesterday during our EWO live session is the fact that we needed to watch and see if we were able to close above 540, which we were. And then the question would be, can we have a follow-through day today? And technically, if we close here, it counts as a follow-through day, not kind of the follow-through you'd like to have. You'd like to see a little bit more of a movement to the upside, but that does open the possibility of coming up and closing this other gap. Here we close this first one down here when we had the big drop, but we still have the second gap that we can close. We do have still pretty decent separation between the 10 and the 50-day moving average. You should know those rules by now as well. If you've been watching, if you're new, one of my trading rules is no security in any time frame gets too far from the 10-day moving average, at least not for long. And then on top of that, you also have the same type of scenario when the 10 and the 50-day moving averages separate. So yeah, they tend to, if I condense the chart in, move it back, you can see how they tend to move very similarly. And then you start to get a little separation, comes back down, a little separation, comes back down, same thing. And it works the opposite way as well. So that's more separation between the 10 and the 50-day moving average than we've seen in quite some time, as you can see going back a year or so. So it does seem like maybe the market wants to try to drift a little bit higher. That's what I would expect. I don't think we're going to get any sort of a big rally higher, but maybe, who knows what news comes out. The Fed Fund Futures is back on a watch of June for a potential rate cut. That could spur the markets higher. But the question becomes, is the bottom in? And I think that as far as a significant bottom, I think it's likely. That doesn't mean that we can't come down and test that bottom. And just as a reminder, when you test a low or test a bottom, it can occur one of three ways. One, you come down and you have a higher low, very similar to what this was, but that doesn't really count as a test because it was the next day. Or you come down to the exact place that the low was, creating a classic double bottom scenario. Or the third scenario is you actually slightly take out the previous low, scare the heck out of everybody, and then the market turns and moves back to the upside. So the possibility of testing that low exists. We don't have to test the lows. It just happens often. But if we do, that's one of the three things to watch for. But it won't be significantly different than this if it is indeed a test. Now, if we come up here and label the wave 4 and roll over again and start down to a wave 5, we could come down to where this next support line is, or even this 161.8% extension on the zigzag pattern. That would be the second extended level. Just as a reminder for those of you that may be newer, when you have a B wave in a zigzag pattern that goes, call it the 38.2% fib level, your target is 61.8. Oftentimes, zigzags will have an extended C wave. They'll go to the next fib level, which in this case is 100%. We've already done that. And then the farthest one, which would be the second extension, is 161.8. And that's happens, but it's far more rare than getting the first extension happens quite often. But the second one is far more rare. And we got almost to that point when we had the big spike in the VIX. So we're going to watch where we close today, see if we can count this as a follow-through day. And if so, then I think there is a good likelihood we drift up and fill this gap. If we don't, then you have to reset everything. We have to start looking at this as a wave four bounce and perhaps a movement to the downside. So a lot depending on where we close today. The closing price always important, but when you have scenarios like this, even far more important. So three things we need to do today: stay above the 10-day moving average, close above 540, and close higher than yesterday's high. Those are the three things we'll be looking for into the close. I do want to go to the bond market. I'll come back to the other markets in a moment, but I want to go directly to the bond market because that's what's helping. We had the craziness that occurred. If you watch the U.S. market update over the weekend, I explained this a little bit, what was going on here. And remember, this is TLT, so that's prices. Prices and yields move inversely. So as prices are coming down on the TLT, yields are moving up. And as rates were going up dramatically with this big fall in prices, we had China and Japan selling some of their treasuries. I've been opining that I don't think that's going to be something that is long-lived or too significant. I think those were just shots across the bow, if you will, with all this tariff stuff and reminding the U.S. what they can do because they hold so much of our debt. And the bottom line is we are the consumption engine of the world, and I don't think Japan or China, either one, wants to crash our economy or crash our markets because they do hold so much of our debt and they want to sell their stuff here. So we'll get the tariff stuff figured out over time, I believe. But I don't think anything too nefarious will come out of that. On top of that, as rates were dropping down, likely some money was coming out of the bond market that ran in and hid right in here when prices went up. That was when money was leaving equities and going into bonds. So I think some of that has come back out and ready to go into equities. Whether or not it's been distributed yet or not, I don't know. But I think there is some cash on the sidelines that companies have raised. And then the final scenario here on this reason that rates have moved down. So we have China and Japan. We also have the money moving out. And then we have the unwinding of a rate swap trade. And that's where it's a common thing with financial institutions where they will pair floating rate instruments against fixed rate instruments. It's kind of an arbitrage trade where they capture just a small spread between them. This is very similar to when the yen carry trade unwound. What was it? Back in November or whenever, when I was calling it Yen Monday, we had that happen on a Sunday night. Same type of thing here. That trade had to get unwound, and that created some problems. And then we also have in the treasury market with treasuries moving higher. I'll go to the TNX. We had the fact that the in addition to unwinding that trade, we have the scenario of what's going to happen with the Fed and their injection of liquidity. So all kinds of things going on in the bond market. You've heard me harp on this numerous times. You got to keep an eye on the bond market if you want to be a successful equities trader. You don't have to be a bond expert, but you should have a working knowledge of how the bond market works because it's so big. Dwarfs the equities markets as far as assets in the bond market. And the treasury market moving to the upside through all that. also was tying into companies that were having margin calls from the big move down in the market. So we go back to the S&P just to give you an exact example of this. When things went down like this, a lot of investment companies use leverage. And when things go down this quickly, one, they have to have a certain amount of cash on hand for redemption requests. So they have to raise cash for that. And then when they have margin calls, unless they want to just get out of their position, they have to raise cash to cover the margin calls. So all those things, all that stuff has played into what was really a bond wreck last week. So back over here to TNX, and you'll be able to see that we have the TNX is rates, where the TLT is prices. So they move inversely. And here's the rates on the 10-year, and you can see rates coming down today, and that's helpful in keeping the market calm, at least for now. We seem to be fairly stable. We open higher, we move lower, but kind of going a little bit on the sideways market. We did have a little bit of a bid under some tech stocks yesterday, with President Trump announcing over the weekend that smartphones and computers were going to be exempt from the retaliatory tariffs, but then came back later on Sunday and said, well, they're still going to be subject to the 20% fentanyl uh, tariffs, and he wasn't saying that they're going to be exempt forever, just for a period of time. So again, it leaves the uncertainty, which I think will keep the VIX elevated. Speaking of the VIX, we'll go take a look at that. And we are coming back down significantly, and we have broken at this moment just below 30 on the VIX. And we'll see if we work our way back down to this 22.5 level, which I think, if the bond market remains in check here and stays calmer, I think it's likely that we do move down. Remember, we had all these ranges here, where we had the big range between 12.5 and 17.5 for a very long time. And then it kind of got moved up at the end of last year into this range between 15 and 17.5. And then we broke above that, and we tested 17.5 as a low, 22.5 became resistance, and then the big explosion to the upside. So we'll see if the VIX remains calm, but things are still a little dicey, and at any point in time, we could start to regain some volatility. So we enjoy the calm while we have it, but still need to stay vigilant and cautious, I believe, in the equities markets moving forward. Let's look at the dollar, because that's been a big deal. And at least for today, so far, the dollar has stopped its dramatic downward move. This was concerning to me, and I know I'm really picky on here in the dollar. If you've heard me talk about it, I kind of want it to stay in the Goldilocks area, which for me is between 100 and 104. That's where I'd like to see the dollar. We don't want the dollar up this high. When the dollar gets that strong, it hurts companies with international exposure. We're global economies, so the exchange rate that they have to pay when the dollar gets so strong goes directly to margins, and that's not good for companies when they report earnings. So it could be a questionable earnings cycle that's just gotten underway. But the dollar coming back down is going to be helpful for that. But we don't want to lose the dollar. We don't want the dollar to collapse, because we do have a lot of debt, and we need the dollar to stay as the currency of last resort when things start going squirrely on a global scale. So we do need to keep this dollar relatively strong, but just not as strong as it was. So breaking below 100 gets a little concerning, because we could go significantly lower from here. That would worry me if we start to see the dollar renew its downward move. And note where we are from the 10-day moving average. Everything works that way. We've had a little bit of a separation here from the low and the 10-day moving average. So we need to see that come back up and have this 10-day moving average kind of start to level off a little bit instead of this vertical move lower. So perhaps that keeps a little bit of a bid under the dollar, at least for the next few days. And we have a holiday shortened week. Remember, the markets are closed on Friday for Good Friday. So Thursday's the last trading day. It was opining on the U.S. market update over the weekend. What are managers to do? What did they want to do over the weekend? Because with 2 days, who knows what kind of tweets could come out, what kind of news could come out. And we did get that news on smartphones and computers being exempt from the retaliatory tariffs. Now we have a 3 day weekend coming up. So I have no idea what's going to happen on Thursday, but it's going to be very interesting to see how money managers decide to square their positions moving into a long weekend with so much news that could come out over that time frame. But for now, the dollar hanging in there and stopping this falling knife scenario is very important, in my opinion, as far as the longer term health of the economy. We know the Fed is injecting liquidity, even though they're not cutting rates. They have multiple ways that they can inject liquidity. And behind the scenes, if you watch not this past weekend, but the weekend before's U.S. market update, I did show some charts from the data scientists at the Hub organization that was detailing the Fed's injection of liquidity against the S&P. Kind of a fascinating chart. If you didn't take a look at that last week. All right, let's go into some of the rest of our markets. We take a look at the Dow. A lot of these charts are going to look quite similar here. You can see that we have basically an AI signal, but it's not high enough. So that's on the software. And by the way, if you haven't gotten a copy of this software, go to hubb.com. And you can get a copy of this new Hub software platform with LA Wave in it. I think it's the best LA Wave software that exists. It's free and lots of neat features on there. Zack will come on later and show the social media aspect of it towards the end. But looking through this area here on the Dow, also looking if we were to close here for a doji. So that could change things a bit. So we got to keep an eye on, again, where we close. We did fill this first gap on the Dow as well, but on the DIA specifically, we still have that other gap to fill. So very similar looking charts between the S&P and the Dow. That's how it normally is. They do change patterns from time to time, but they normally work in some sort of similar fashion, some sort of symmetry, if you will. But now we move to the Qs. And even though the pattern is very similar here, we're kind of lagging here today from where we are on the Qs. But on the positive side, they've already filled that second gap. So we got a little bit further ahead on the Qs, and then we've backed off a little. The fact that we've already closed that gap means that anything can happen on the Qs. We have the separation between the 10 and the 50-day moving averages, just like we do on the SPY. So again, I do feel like we'll be constructively positive throughout the rest of this week, as long as the bond market continues to behave. And if it does, that's what I think is going to happen. We'll still have to wait and see if we have to test the lows. But I'm just talking about the near term and where things are right now. That's all you can do as a technical analyst, is analyze the data that you have at any one given point. So that's what we're doing right now. But the fact that we've already filled that gap, does that mean that we don't get a drift higher in the Qs like we will likely in the SPY and the DIA? Again, I think that goes to where we are with interest rates. At some point in time, people are going to start nibbling again on the tech stocks that have been just decimated, and perhaps money moves in there and we do get a renewed bid. But we have to also respect the potential for just a choppy sideways movement in the Qs now that that other gap has been filled. And in the IWM, we're getting a little bit of a bounce finally. This is the one market that's been acting exactly as you would expect in concert with the bond market. When rates go up, it's not good for small caps. We've detailed that in the past as far as why. But look at this zigzag pattern, just so classic here. Why I love zigzags, especially in the wave three. This is how you can determine where a wave three may end. If you're not familiar with LA wave rules, a lot of people, when you learn LA wave, say stay away from the wave three, even though it's widely agreed upon as the strongest of all waves. And so my thought process is, why would we want to stay out of the strongest of all waves? But the viewpoint is it's very difficult to know where the wave three is going to end. Well, if you have a zigzag pattern, my contention is that you can figure out where the wave three is likely to go, and then you can see how well these zigzags work. So the B wave here at a 50% correction, now that yields 100% extension. The 38.2% B wave correction gives you 61.8, but with a 50%, you're looking at 100, and then the extended level is the next level at 161.8, which is exactly where we went on the IWM. And with interest rates rising, you can imagine that the IWM was falling and falling big, and it was. And now that we're getting a little bit of a break in rates, at least over the past couple of days, we're starting to get a bid back in the IWM. This could be a very interesting place to be. And Zach, this is going to be our case study consideration for this week. A little more of a shorter term one than I normally do, but I think that if we're looking for the market to at least drift up, we could get a more exaggerated move on the IWM. Now, there is a caveat there on the bond market. The bond market starts acting bad again, then this trade won't work. But as long as the bond market is calm, I think we could see a bounce back up to 200 here on the IWM. So that's what we're going to be looking at as far as our case study. Now let's go ahead and look at what's going on in metals. As you know, gold has just been on a tear. And yesterday, it seemed like maybe we were going to pull back a little bit, but now here we go, right back up again. We did think the GLD was going to hit 300. If you've been watching for a few weeks, you know, we expected that to move. Now here's another case where we had two extensions on the C wave. So we had the 38.2% B wave correction. We went up to 61.8. That was the first target. And we went right through that. And then the second extension level of 161.8 is, again, rare. But we're still separated from the 10-day moving average. So I thought we might see a little more pullback in gold today, but it's hanging in there. And the wave three is still active. That's why it's in green when these confirmed waves turn purple. So we could even go higher from here. I just think that that would be unusual. Well, I know it would be unusual, but it is possible. And I also thought hitting this big round number might act as some resistance, and it still may. It has so far. I guess my point is I just thought maybe we would see a continued pullback, at least back towards the 290 level on GLD, but not so much so far in this trading day. But again, if we close here, look, it's Doji day. If all the markets close here, but with 2.5 hours to go, who knows where they're going to close? But there's potential for a lot of dojis, which means a lot of indecision, and anything is liable to happen tomorrow. So even though we're closely watching what happens at today's close, we got to watch tomorrow as well. So a couple important days on SLV. I still think SLV is going to play catch up at some point. I could be wrong. I know it's tied to manufacturing because so much of technology uses silver these days, and it seems to have gotten lumped in that grouping and acted more along the lines of these tech stocks crashing than gold's ascent. They normally move fairly well together, but that distinction is keeping silver a little bit lagging. I just feel like at some point in time, silver is going to have a big run and kind of catch up to what gold's doing. As you can see, it's got a long way to go. And I think that could be a very interesting trade. We've been talking about that the last couple of weeks. And I think at some point that's going to be a nice, rewarding trade. But we'll see. Once again, depending on how the bond market and tech stocks act. As we move to energy, looking at UNG, wondering if we could get a wave 5 impulse here. But breaking down today, the positive news is that we're at the 61.8% fib level. which is the strongest of all fib levels, my favorite fib level. And this is a place where it could hold. Thought maybe it might hold this 17 and a half level. Last week, I believe we talked about this, that it could potentially hold there and move higher. But even though we've broken 1750, if we don't get a follow through day tomorrow, perhaps we just needed to come down and test that fib level and then we can bounce. But if we break below this level, then I think we're probably completely breaking down here on the whole UNG trade. Remember, we got the bid because all of a sudden the realization we're coming out of the wintertime season, which is normally real positive for natural gas, and we didn't get the rally till the end of the winter time. But the reason that we got this bid was because all of a sudden people realize, wait a minute, all these data centers that are being built are going to be using natural gas to run, and we got this big bid. Then we have all these issues going on in the market, and now there's speculation of some companies are going to delay the building of the data centers, and then the unknowns of how long will it take them to get built, how many are going to be built, how much natural gas are they going to use once they are built. So all these unknowns came back into the market, and just another rule to remember is the market hates uncertainty. The market can deal with anything that is occurring as long as it has an idea of what's likely to occur. When there's uncertainty, that's when the markets just err on the side of let's just get out and we'll wait for another day. So that could happen in natural gas, but we got to respect this 61.8% fib level. I think we could get a bounce from there. But if we don't, then again, I think we're probably coming all the way back down here to the 15, at least on natural gas, and then maybe wait for another day for the market to calm down a bit and start this move back up again in natural gas. With that caveat out there of the data centers, et cetera, I don't think we go back down anywhere near the lows of where we were with natural gas. I think it keeps some sort of a bid underneath natural gas, but we'll just have to wait and see exactly where that bid may be. And then oil, which is really interesting right now. And we had a great discussion about this, people talking about it in the U.S. market update over the weekend. And it's been one of my points of contention, exactly what people were commenting on. Oil has come down significantly, and people lamenting that, well, my prices haven't gone down in my gas pumps. And I've always talked about this over the years. I remember this is 28 years, I believe, that I've been doing this. And I noticed this a long time ago. I'm sure you all have as well, that when oil goes up, it seems to be reflected at the gas pump the very next day. But when oil comes back down, it takes weeks before the prices start coming down. And the oil companies are like, well, yeah, the price of oil is coming back down, but we have just bought that. We got to refine it and get it to the pumps. That takes time. But why doesn't it take time when prices are going up? Because the oil that's at the gas pump was already refined and shipped from the previous lower levels. So anyway, they get away with it. I've talked about President Obama back when he was president, made a comment, he noted it, and he made a joke out of it. And I was like, well, do something about it. I mean, if you know that's what's going on, why do we let them get away with it? Oil has big lobby, you get in all the political stuff, et cetera. But the bottom line here is that and when the market moves in extreme one direction, it oftentimes moves extreme the other way. So we broke a little bit out of this trading range that I thought we were going to be in on the upside. So we broke out of it to the downside. So now we went extreme one way, extreme the other way. And I do think we level off and probably slowly start to drift back up here. But it will be helpful because by the time we get into the peak driving season, the summer vacation time, prices should be lower at the pump by then, and that should entice people to continue with their vacation plans who may be thinking, the economy is softening a bit. Do we really want to go on vacation? And perhaps change their plans a bit. But airlines have reported that bookings have dropped off more than they thought they would. So people aren't flying as much, but maybe they'll drive. Maybe they'll still go on vacation and they just say, instead of flying, we're just going to drive because prices at the pump will be cheaper. But I don't think we go much lower than this. I think OPEC, when they were seeing this, was starting to get a little bit itchy on maybe we need to cut production, but they are mindful of keeping the supply demand curve in balance. They do want oil prices to stay elevated, but they don't want to quelch demand because when you do, it tends not to come back. So they don't want oil to get so high in price that it runs more people to electric vehicles. And It's been pretty sticky. The people that have bought electric vehicles tend to like them. I know all the stuff that goes on with Tesla, et cetera, but that's different. The numbers of people that have switched to electric vehicles and then continue to hold them is pretty solid. So OPEC's aware of that, and they're trying to be mindful of that supply demand curve. But this will be helpful to the economy when we start to see those prices reflected at the pump because it keeps a few extra dollars in the consumer's pocket. And as consumers in the US, we spend. So more money to spend going through all that. So now let's talk about with everything that's gone on in the world of the markets, a few international markets from the domestic side over to internationally. We'll take a look at the Aussie market via the EWA. We look at both the EWA and the XJO on Thursday nights in our insiders meeting for subscribers at ewotrader.com. But you can see here, we had the wave three, it came down. If we didn't hold 21, we were going to go down to 20, but we did hold on this wave three. That's confirmed now, and now we have a confirmed wave four. So that's a little bit disconcerting. The wave four is right at 50%. We're back above the 10-day moving average, but we haven't broken the 50-day moving average yet. You know how the triangle stuff works when you have a triangle breakout. So here was an ascending triangle that broke to the downside, furthering my point that you don't ever pick a direction. I know there's a lot of information that descending triangles break down, ascending break up. Well, no, here was an ascending triangle that broke down. Any triangle can break either direction. And then once the breakout occurs, you usually come back up to the point of the breakout. So that's what's going on here, and a 50% corrective move in the wave four. So we have to wait and see if we are going to start a wave five down, or could we move higher and disqualify this pattern? But this is kind of D-Day here, the line in the sand for the EWA. And then as we move to Canada, which is really amazing to me that it didn't perform worse. It did finally succumb to the selling that we had here in the U.S., but with all the rhetoric that's been going back and forth between the U.S. and Canada, I would have thought that we would have broken down sooner, but we held in there pretty well until last week when we had the big downward move here in the U.S. But now right back up. I mean, that's amazing to me with all of this stuff going on with the tariffs and the commentary back and forth. Back above the 50-day moving average on the EWC. And I know we look behind the scenes and there's some pretty big stocks that are helping to keep this ETF probably more reflective to the upside than the actual economy in Canada at the time. But nonetheless, we look at this chart here as a general idea of what's going on, and back above the 50-day moving average is pretty impressive. So the level to watch and continue to watch here is 40. You can see that this wave five is labeled purple. So we had 135% extension. We went right to the bottom of the tap box. Again, great LA Wave software from hub.com. The algorithm is right as Ralph Nelson Elliott wrote it. So we came right to the lower end of the tap box and we're moving back up. Now, the interesting thing about Canada is the fact that, or the EWC chart, is when you have a wave five that extends more than 100%, you don't necessarily look for a move back to the previous four, which is typical LA wave rules. If the wave five doesn't extend more than 100%, you go back and retrace the entire wave five, so you go back to the previous four. However, if you extend more than 100%, you're only looking for a 61.8% corrective move after the wave five. And so as we draw that in, you can see we've surpassed that. So the 61.8% level was right here. So we would have looked for this move back up here, which made sense. That's why I drew this line here, because not only was that the 61.8% correction, it was also a good point of support resistance. And we've broken above all that. So perhaps we do go back up to a full retracement of the wave five. I'm just saying that based on rules, that doesn't have to happen. Obviously, it can still happen, but it's not what you're looking for. So we've moved a little higher on the EWC than I thought we might. And then going to the EWG, this market has just been surprising as well. We did finally break down with the German market, and then here we go right back up again. Now the ECB is way ahead of us in cutting rates here in the US. And as a reminder, we've taken, at least at this point, kind of the May rate cut out of the Fed fund futures and looking towards June now. But it's not that far away. But the ECB is well ahead in cutting rates, and there's no doubt equity markets love rate cuts and liquidity. And even though we did get this quick move down to a wave four, just absolutely barely by the tip of our fingernails, hanging on to a qualified pattern here. The last bastion is 78.6, so pretty close there. And perhaps we can still have a wave five with all the tariff stuff and everything else. Having that 90-day pause has helped in the Eurozone, I believe, move back up, and we may move into that wave five here. And notice that the wave five forecast is not too significantly higher from the wave three. And I think that makes a lot of sense. It had such a big run. And the economy in Germany is not that great. It's just this is all because of liquidity and quantitative easing going on from the ECB. So I wouldn't expect this to be too much of a run above that wave three if indeed we get there. I think that would be asking a bit much. And then taking a look at the Nifty over for India. If we take a look here, you can see that we are trying to build a little bit of a move. And I noted here when we were looking at this prior that we did get the 61.8. This was the point I was just making on the EWC. The wave five extended more than 100% on the way down on the Nifty, and we move right back to the 61.8% level, because remember the rule I just went through, you extend more than 100%, that's what you're looking for on a bounce. When we came back down, the positive is at least we made a higher low, and now we're back up again, getting ready to test this. But I think you just have to be very cautious on the market in India right now. See if we can break above 61.8. If we can, then perhaps we're going to be moving back to that previous four all the way, like I was just talking about with the EWC. But I think just for right now, let's watch the market here in India for a couple of days before we decide that we are likely to move back higher, because it's done what it's supposed to do already based on Elliott wave rules. Just spot on. I mean, look at that. And it's, this is why such a big believer in Elliott wave. Actually, I'm not going to take that. I'm going to leave it on so that we can see where it goes from there. And then I thought I would, last but not least, take a quick look at what's going on in China. And then from there, we will open it up to Q&A. And we're getting a bit of a bounce back, but not as much. And I think that makes sense too, because the tariffs are still higher for China. This move here was a bit surprising to me, but we've retraced that, came back down, held support there at 30, and we're trying to bounce again. A little bit of separation between the 10 and 50-day moving average, but not too significant. A little bit of a doji yesterday, not a real classic one, but kind of in the doji neighborhood, and it looks like maybe we're doing that again. So the key to watch here on the FXI, if you're wanting to try to move into the market in China, which has just been lagging the rest of the global markets, is 32 and a half. So watch that level. I think if you want to be really aggressive and assume that the US and China will get out of this tit for tat back and forth on all the tariff stuff, we raise it, they raise it, all that stuff. If that calms down, which you have to believe it will, because we still, as much as President Trump wants to bring manufacturing back to the U.S., there still will be a lot of goods manufactured in China, and China needs us to buy those things. So I do think they'll work something out at some point. I don't know where it'll be or when it'll be. But at that point in time, you could get a renewed bid in China. But as long as the FXI, as a representative of what's going on there, stays above 32 and a half, if you have some speculative money, I think you could keep that to work. But if it breaks below 32 and a half, that's your stop. You get out then and then just wait for another day, because we're probably going to come all the way back down to 30 again if we can't hold 32 and a half. And the reason I say that is, notice these two moves were quite vertical. So from 30 to 32 back in January was moved rather quickly. And then same thing here, when we broke 32 and a half, we came down fast and went right back up fast. So 32 and a half is really important. Again, we don't hold that, we're probably at 30. So be mindful of that. All right, Zach, with that, go ahead and take a few questions, and then you can show the folks how to put that idea in for the IWM.
Yep, sounds great. Thanks, Rob. Let's get right into the questions. Couple of symbols from Irv85. First one's going to be Meta.
Oh, yeah. There's some stuff going on legally with Meta right now. I'm sure you've all seen the headlines, etc. And that all has to get worked out. But that kind of, at least for the short term, stop the big run that Meta's on. And I think there's just waiting to see how that all plays out. This wave 5 pattern is disqualified because that wave 4 did come all the way down to 82. So that's a disqualified pattern. And then people will say, well, why does it still show? And the other rule is when a wave 4 takes out the wave 1 high, it disqualifies the pattern. That's the part of the algorithm that will make this 5-wave pattern disappear. But you just know the rules and know that when it moves past 78.6, then the pattern is disqualified, and it's only a matter of time before it disappears off the chart. But for now, I think Meta's stuck in neutral until that legal stuff gets worked out. And then from there, I would be very surprised if Meta doesn't turn and run back to the upside, barring some real negatives that come out of the regulatory stuff that's going on with Meta right now. But I think at least until Meta gets back above 550, you got to be pretty cautious here until we're past that. So the key level to watch is 550. If we can break back above that, then we could move higher. But the problem is that we've got a lot of bumps in the road on the way. So we would have resistance here at 575, again at 600, 630 or so. So Meta is going to have a long road to move back to the upside. So I don't think it would be anything that happened real quick. Maybe we get a bounce if it comes out favorably on the regulatory stuff, but it's got some resistance in the way on moving back to the upside. So I think you'd have to be patient on Meta. So maybe go a little further out if you're an options trader on Meta.
We'll follow that up with AMD.
Um, we're keeping the flow alive, Zach. AMD every week. So we'll take a look there. And I think this one is really interesting. I think you can see in the last I drew this arrow. Now, the wave 5 here, again, right in the middle of the tap box, this amazing Wave software. We do have some resistance here at 100. So I thought we could get a quick trip back to 100. It looks like that's going to happen. But if we can break above 100, then we're probably coming all the way back to this previous four, which is very close to 125, not quite there. But the easy part of this trade is over, which was the bounce up to 100. And we'll see, since that acted as a bit of support, how much resistance is that going to be on the move back to the upside. But I think there's going to be some money rotation if the investment managers start to feel like the bond market is calming down, they'll be looking for places to go. And I think AMD is going to be one of those places. So I'm constructively, I guess, bullish on AMD. But as far as right now, let's let it get back above 100. And then we have the 50-day moving average right there. But there's still plenty of room to trade that move back up to the previous four. So we got the bounce I was looking for. Now let's let it get back above 100, and then we'll go from there.
Couple of symbols from Manuel. First one's going to be dust, D-U-S-T.
Whoops, not dusty, just dust. So looking at the gold, these, I hate these things. And it's personal preference. But when you start to get these multiples on these ETFs, so this is short, the miners on ETF, but in order to get that extra leverage, they bring futures contracts into it. So you get a double dip on time decay. These are actually designed to go to zero. If you get the timing right with the leverage, no doubt that you can do well, but you have to get the timing right. Otherwise, they start to erode in value. And so if you have puts on this, you're doing fine. I'm not even sure if this is optionable or not, but let's actually take a look real quick and see if there are options here available on. There are. Okay, they're not very liquid, but there's some that are there. So if you are trading options, then puts would have been working well. But we're going to have some sort of a massive move down in gold for this to bounce. So if you're waiting for gold to pull back and the miners to pull back, that could happen. As I said, I think gold's a little bit overdone short term, but with the Fed cuts on the horizon, I'm not sure how much of a pullback we get in gold. And as long as the dollar is staying soft, that's going to help keep a bid under gold. Gold moves a lot in relationship to the dollar. So if you short this, I think that's kind of the place to be. Maybe not right now because we are oversold from the 10-day moving average. But please understand the risks of these when you get these multiples on these ETFs, that you're fighting time decay. So you don't want to hang around a long time. Oftentimes, I'll be pretty patient and let patterns develop. But if you are trying to trade these for the long term, it becomes very difficult because they erode in value so quickly. So, all right. Next one, Zach.
Next up, we got V for Visa.
I'm kind of interested to look at this one myself. So the credit card companies have been saying that the consumer spending is held in there pretty well. Obviously, when we have a big move down like we did, it just takes everything with it. And it brought Visa, but look how fast it's rebounded. I don't like it when the wave four is just one bar, but we did test it for a couple days near the low. But we're right at the 61.8% wave four correction. We are moving into the summer vacation driving season, people traveling, maybe not as much as expected on the airlines, but I do still think people will take their summer vacations. The economy has softened, but it hasn't collapsed. So I'm pretty constructively bullish on this one as well. But the level you want to watch is 330. As long as it stays above 330, I think you can stay long Visa. But if it breaks below 330, because we had again a move up from 310 to 330 pretty quickly, you can see what happened when it fell. But again, that's easy to say because everything fell hard those days. But if it doesn't hold 330, it could do that again. It could be back down at 310 rather quickly. But as long as it stays above 330, I think you can stay long Visa. Kind of like that one myself.
Set over to Apple. Specifically, the user has puts at 210.
Puts, they they got a bid when that announcement came out, and that's the problem with holding something over a weekend these days. And that was what I was talking about as far as what's going to happen with the holiday weekend, with the smartphones and computers being exempt from the retaliatory tariffs. We had a big move to the upside in Apple. And we are at a little bit of resistance here at that A wave impulse on the downside, but also note that we had a 38.2% B wave correction. 61.8 was the target. We hit that. We went down to the further extension level of 100%, almost went to the second level. And so there is a chance that Apple bounces all the way back up here to where this B wave is. So if you've got puts on it, you want it to stay below 210. I think if you're bearish on Apple, as long as we stay below 210, you can be okay there. You can see it tested it yesterday and couldn't hold it on that news from the weekend, finishing near the low of the day. So, it is leaning bearish. So I understand why you have puts on it. And it could run right back down here to the C wave extension rather quickly. However, if it breaks above 210, I think that's your stop on the puts. But for now, that seems to be the right direction. I've always said that Apple is the one company that I'm more nervous about shorting than pretty much any other company because they have so much cash and they initiate their stock buybacks. And they can keep a bid under the stock at any time they want by authorizing significant buybacks. So I always kind of hold my nose when you're talking about going on the short side on Apple. But those are the numbers on the technicals. If you got puts, the negative is that you're still above the 10-day moving average. But the positive is that it did get turned back from 210, which matters. And as long as we stay below 210, I think you can stay in those puts.
Thanks, Rob. Got a couple of requests for SLV, specifically a question on considering a delta neutral trade on SLV as it's right on its 21-day EMA.
That's Jeff's territory there as far as the 21-day moving average. I've got the 10, 30, and 50 on my screen. The 10-day is that lime green. The fuchsia colored line is the 30-day. And then the blue line is the 50-day. And that's something that I got from market makers a couple decades ago, that the floor traders would look for the 1030 cross as an earlier indication of what the 50-day was going to do. The 50-day is widely viewed as the trend indicator as far as a moving average. And then when you get these crosses, it can give you an early indication, but you can see it looks like we might be about to get a whipsaw here. I understand the idea of doing something delta neutral. So when you say delta neutral, that could be a strangle, which means you think it's going to break either direction, or it could be a butterfly iron condor or something along those lines where you think it's going to stay sideways. So there's a couple different ways of doing delta neutral trades. So I'm not sure what direction leaning towards the delta neutral side of things. I think I'd be a little bit more inclined on the strangle side of things because, if the market falls back apart, silver could go down. Otherwise, I think it's going to play that catch-up move, so it could break out of the range. So that's the part of delta neutral I would be looking at, on whether or not it breaks higher or lower. But if you're a believer that it's going to settle in sideways, then you would be looking at a range probably here between this congestion through here at 27 and a half. That would be the lower end of the range, and then Clearly, the upper end going back to October of last year is at 31. So that would be your range if you're looking for a sideways trade, in my opinion. Um, I just feel like silver may move, but I could be wrong.
Let's check out Netflix for Will.
They're just talking about Netflix. Will, I don't know if you saw it just before we came on or right when we were coming on. Ah, pardon me. Oh man, having a bit of a windstorm today, and it's really blowing the pollen around, giving my allergies fits. But you can see the move up. Netflix came out and said they felt like they were going to double their revenues in the next 5 years. That's a pretty big deal. It seems difficult to imagine. Um, I mean, how many more people are there out there that don't have Netflix already? I'm sure there's a lot, but enough to double their revenues. But that's what they expect, and maybe they have some other things in the pipelines. I didn't listen to the entire commentary about it, but that's why Netflix is up big today. And then we're back up at this 1,000 level. So, well, I think if we break above 1,000, we could really be off to the races here. So that's going to be the key level to watch on Netflix. But pretty bullish sentiment. A wave four that's right at 61.8. We are now on the high of the day, a little bit above the 10-day moving average. So maybe we need to bump our head against that 1,000 level. You can see what happened last time. But I think if we break above 1,000, then that wave five is probably going to come into play, and you can see it's could be up near the 1,200 level. I don't know if it's going to take to springtime to move that far, but I think we'll have a Fed rate cut before then. But that's the level to watch. So if you're really aggressive and you want to go long on this news, just watch 950 as your stop. If it breaks below 950, you get out. If you're a little more conservative, let it actually break above 1,000. The old Missouri thing that I talk about, show me break above 1,000, and then I think we could be off to the races again on Netflix. So when a company says something like that, they're usually previewing that they know that their earnings are solid. And yeah, that's almost like raising guidance type of thing.
Very well. I see we're a minute after time, so perhaps I'll head over to the platform to show everyone how to post the idea.
Okay.
All right, so should be able to see my screen now. And this is going to be a official idea for this week, Rob.
Yeah, I'm actually going to make it a full-fledged idea this time. So,
Very well. So we'll head over here to this light bulb up on the located on the tight right toolbar, that is. And as I confirmed with Rob just there, this is going to be an official idea. So you could equate this to paper trading, as in you're going to have all of the same data that you would have if you were paper trading with your brokerage. We will look for a symbol here in the search window for IWM.
are you sure you have the screen?
I shared it. We're both sharing at the same time. Let me stop yours just to make sure. I should have switched over, but just in case.
Okay. I think that's better. I see it now. Maybe everybody else could see it beforehand, but I couldn't, so now I can. So I'm
Yeah,
sure
no,
you're on it
always
now.
gets tricky with the updates, so better safe than sorry. What's the time frame we're looking for the IWM trade, Rob?
Yeah, this one is let's just do the 3 months on this. I don't think it's going to take that long, but um, we'll give it plenty of time.
Very well. So as you can see, I selected the 3-month time frame there. We'll come back and add some supporting details here very shortly, right after the session is over. But I am going to go ahead and publish the idea to ensure that you can go in and interact with the idea, whether you agree or disagree. We always welcome your opinion as long as you have supporting evidence to follow, and of course, respectful of the community. But again, opposing opinions is what makes markets. If everyone agreed, there'd be no transaction or trade for there to be executed on. So as you can see, it's posted. Please feel encouraged to come in and interact. And Rob, I'll pass back over to you to wrap things up.
Yep, we will post a commentary. Just a reminder that that's assuming the bond market continues to behave. If the bond market acts squirrely, then that's not something that you would want to follow. But I'm assuming that we are going to calm down in the bond market, so I like it. But good explanation there, Zach. Social media aspect of the platform is fantastic. I get notifications. They're adding people every day, and we love the interaction, sharing of ideas. Always interested to see what somebody else thinks of your idea, and they're very respectful in the disagreements, and I always welcome disagreements, and I'm sure others do as well, just as long as it's done in a respectful way. It's a great thing to have, and then the curiosity of what others think of your idea. Do they agree with you? They disagree? Why? And it's all great. So with that, thank you for your attention today. As always, appreciate your time very much, and I hope you found that interesting and or informative. And we do need to watch where we close today, and then see if we can get follow through tomorrow. So at this point in time, we've broken down a little bit. Still off of the lows from pre-market, but we went sideways for a while, and during this broadcast, we've broken down a little bit. So we'll see if that hangs in there or not. But again, watch the close. I'll go back to the chart of the S&P as we sign off here, and you'll be able to see that we need to hold that 540 level, which we have broken below now, and see if we can get that follow through. So the last couple hours of trade will be important. Thanks as always.